G'day traders, and welcome back to the Gold Jumper channel for your latest market update. Jump up and under, let's get into it, because the last 3 days have been absolutely wild. Today, we are covering the massive Israeli strike on Tehran oil facilities and the surge in crude. We will break down the golden technicals like the daily Bollinger Squeeze and RSI levels. Plus, the latest macro from Japan, China, and our very own Aussie business confidence data. Just a quick reminder that I am not a financial advisor, so do your own research before trading. Here is the big question. Is gold about to blast past $6,000, or is this a liquidity trap? Tell me what you reckon in the comments, and make sure to like and subscribe for more. Over the weekend of March 7th and 8th, the geopolitical heat turned up to a boiling point. Reports confirmed that Israeli airstrikes hit 4 major oil storage facilities at the Shahran refinery in Tehran. This direct hit on Iranian infrastructure sent shockwaves through every trading desk across the globe. To make things even more intense, Iran named Mojtaba Khamenei as the new supreme leader on March 8th. This leadership shift in the middle of a conflict suggests a long, hard road ahead for regional stability. Traders are now pricing in a massive risk premium because the Strait of Hormuz is effectively a no-go zone. If that choke point stays closed, 1/5 of the world's oil supply is basically stuck in the shed. Safe haven demand for gold spiked immediately as legends looked for a place to park their cash. No dramas in the dip, just more room in the pouch, as buyers stepped in to defend the trend. Physical gold demand on 24/7 marketplaces hit record levels over this chaotic weekend. Now let's look at the black gold, because WTI crude oil went absolutely berserk on Sunday night. West Texas Intermediate skyrocketed more than 17% to reach $106 a barrel. At one point, WTI futures even peaked at a massive $111.24. That is the highest price we have seen for crude since July of 2022, which is fair dinkum scary. Brent crude also followed suit, climbing to around $107 during the Sunday session. The OVX index, which measures oil volatility, hit a staggering level of 103.6. An OVX reading that high means the market is in extreme overbought territory and expects massive swings. High oil prices act like a global tax, which usually spells bad news for stocks, but good news for gold. Investors are worried that this energy shock will bring back sticky inflation that central banks can't stop. If oil stays above $100, it could add 0.7% to global inflation forecasts. While oil was flying, gold had a bit of a bumpy ride as the Asian markets opened on Monday morning. Spot gold stabilized around $5,170 per ounce on March 9th. This was a slight recovery after a brief dip where traders liquidated gold to cover stock market losses. US stock futures plummeted on Sunday night, with the Dow Jones dropping over 800 points. When the big equity indices crash like that, institutional players often sell gold just to get quick liquidity. But the buy the dip crowd came out in force, keeping the price well above $5,000. In India, the domestic gold price for 24 carat stayed firm at 1,61,000 rupees. This global floor suggests that gold is being treated as the ultimate neutral reserve asset right now. Gold is decoupling from the usual correlations because trust in the old financial system is fraying. Legends are choosing bullion over bonds because those 10-year yields aren't providing much comfort anymore. The big names in investing have been very vocal about these movements over the last few days. Billionaire Ray Dalio warned on March 8th that gold's rise is a hidden message about fiat currencies. Dalio reckons that the value of the US dollar is declining in real terms compared to hard assets. He says that hedging currency risk with gold has become a necessity rather than just an option. Famous economist Jim Rickards is still banging the drum for his long-term gold target of 23,000. Rickards believes the global monetary reset is accelerating thanks to the BRICS nations' gold moves. Peter Schiff is also stoked, calling for $6,000 as the next major psychological hurdle. Schiff pointed out that gold is crushing Bitcoin during this crisis as the digital gold narrative fades. Bitcoin slumped to $66,000 on Sunday, while the yellow metal held its ground. These legends all agree that we are in the middle innings of a massive structural bull cycle. Looking at the macro side, the US dollar index, or DXY, showed some strength on Monday. The DXY climbed 0.6% to reach a level of 98.85. Usually, a stronger dollar puts a bit of a lid on gold prices, creating a bit of a tug of war. but the US jobs data from Friday showed unemployment rising to 4.4%. This labor market weakness is making traders think the Fed might still have to cut rates soon. Over in Japan, the news on Monday was actually quite positive for their local economy. The final fourth quarter GDP for Japan is expected to be revised upward to 0.3%. Strong wage growth in Japan means the Bank of Japan might turn hawkish and hike interest rates. A stronger Japanese yen would normally weaken the US dollar, giving gold a nice tailwind. It is a complex dance between currencies, but gold is staying light on its feet during the chaos. China also released some key inflation data on Monday morning, March 9, 2026. Chinese consumer price inflation rebounded modestly to around 0.4% for February. Beijing has set a GDP growth target of 4.5 to 5% for the year ahead. More importantly, the Chinese central bank has been buying gold for 15 months straight now. This central bank demand provides a massive floor that stops gold from falling too far during sell-offs. Back home in Australia, we are keeping a close eye on the NAB Business Confidence Survey. The last reading for business confidence in February sat at +3, which is a bit of a relief. Aussie gold miners are riding these high prices to record highs on the local ASX exchange. While our consumers are feeling the pinch at the petrol pump, the mining sector is doing it easy. High commodity prices are helping our tax revenue, even if the rest of the world looks a bit shaky. Now, let's get into the technical architecture of the charts, because it is looking very interesting. On the daily chart, we are seeing a classic Bollinger Squeeze developing as we speak. The 20-day simple moving average is sitting right at $5,009 per ounce. The price is oscillating around this median line, which usually happens before an explosive breakout. The upper Bollinger Band is at 5,345, which is our target. If we get a daily close above 5,160, the bulls will be running wild. On the downside, we have major support at $4,980. If gold breaks below that, it could slide back toward the 50-day average at 4,600. But the long-term trend remains as bullish as a rogue steer in a china shop, so don't sweat it. Institutional accumulation is clearly happening while the price grinds sideways in this narrow range. Moving to the 4-hour chart, the trend is looking like a solid rebound recovery structure. Gold successfully reclaimed its position above the Bollinger Middle Band at 5,135. The short-term moving averages, the MA10 and MA20, are starting to point upward again. Resistance on the 4-hour timeframe is currently clustered between 5,180 and 5,200. On the 1-hour chart, we saw price stabilize near a recent low of $5,050. The fast-moving averages show a bullish alignment, meaning the 5 is above the 10 and the 10 is above the 20. The Relative Strength Index, or RSI, on the daily chart is currently sitting at 57.46. That is a nice neutral to bullish zone, meaning there is plenty of room left before we get overbought. The MACD indicator is also showing signs of flattening out, suggesting the selling pressure is gone. Momentum is slowly shifting back to the buyers as they protect the key $5,000 psychological floor. Let's talk about the big moving average crossovers that everyone keeps mentioning on the forums. The 50-day simple moving average is way above the 200-day average, which is a massive golden cross. The 50-day average is currently at $5,129 per ounce. Compare that to the 200-day average, which is way down at $4,061. This massive gap tells us that the primary bull market is very much alive and kicking. We haven't seen anything close to a death cross, so the long-term outlook is still pure gold. Short-term corrective pressure still exists on the 1-hour chart, but it looks like it's being digested. Any dip toward the $5,000 mark is being met with a wall of buyers and central bank orders. This is exactly what we mean when we say there's no dramas in the dip. Legends. Just keep an eye on that $5,185 level for a breakout signal. To wrap up the levels, your immediate resistance is at $5,180. Above that, the next big hurdle is $5,230 to $5,250. If we clear those, we could be looking at a retest of the all-time high near $5,600. For support, keep a sharp eye on $5,130 for the short term. Structural support is much stronger, around $5,100 and $5,080. The ultimate line in the sand for this week is that big round $5,000 level. So, to summarize everything we've talked about today, gold is holding firm despite the chaos. The Middle East conflict and the strike on the Tehran refinery have made gold a top safe haven choice. Oil prices hitting $111 is fueling inflation fears that are bullish for bullion. The technical charts show a Bollinger Squeeze that is primed for a massive move very soon. Major investors like Ray Dalio and Peter Schiff are telling us that fiat currencies are under serious pressure. Central banks in China and elsewhere are still hoarding gold, giving us a solid floor to stand on. The Aussie dollar and Japanese yen are providing some interesting macro twists to the price action. Overall, the market is in a buy-the-dip mode as we navigate this crazy geopolitical crucible. What do you think comes next? Is gold going to hit $6,000 by the end of the month? Jump into the comments and let me know your price targets. And don't forget to like and subscribe. Stay active, stay legendary. Catch ya.